Everybody. We're just starting the webinar with Rob. We actually went through some interesting stuff today. Depending how we close today, a lot of these charts, SPY, Qs, IWM, we're into or below that 50-day. We're starting to bounce back here. I just took a long on RTY, which is like IWM for futures. And Rob's going to go through the charts for you. He'll discuss what we talked about this morning in the chat. And how important it is. If we close under the 50-day, we could test down to the 20-day. If we hold above it, Rob actually liked that scenario. If we stayed above the 50-day or closed above it, so I'll let him take over. Go ahead, Rob.
All right, thank you, Frank. Good afternoon, everyone. Welcome to another Wednesday webinar. My name is Rob. Also, you can follow me on Twitter or YouTube as Stock Darts, and the person you just heard talking was Frank, also known as Stock Guy 22. You can also find him on Twitter as Stock Guy 22 or YouTube as Stock Guy 22. You can also find some of my trade ideas and some of my thoughts on the markets and on different trades at patreon.com/stockdarts. As usual, we're going to go ahead and cover the four major market ETFs. We're going to look at the S&P 500, we're going to look at the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish with that, we'll take a quick look at the US dollar. We'll see how it's faring versus other currencies such as the euro, the Canadian, and the Japanese yen. And we'll see what kind of impact they might have on gold and silver and oil. Once we finish going through these sort of broader markets and big commodities, we can go ahead and take a look at chart requests. So if any of you guys have chart requests, feel free to put it into the chat, and we'll be able to get to it once we finish going through those. Like Frank said, the markets are testing their 50-day moving averages across the board, basically, and it'll be interesting to see what happens from here. We discussed last Wednesday this idea that the markets were getting a little overextended, right? We hadn't even seen a green candle across. I think on the S&P 500, what did we have? One red candle in the first 3 weeks or so of trading. And it wasn't until yesterday and today that we're finally starting to see some selling. And what we discussed last Wednesday was this idea that sooner or later we had to correct. Obviously, we're not going to just print green candles the rest of the year. And what I'm really interested in seeing is how do we behave once we start to see selling coming into the market? Once we start testing these bulls that have kind of come in with this newfound vigor and this new sort of exuberance and just pushing the market right back up towards last year's range. What happens once we get selling? Do they head for the exits immediately, or do they sort of sit back and wait and say, no, I think we want to hold longer? And I think that's where we are now. We're finally going to start testing the bulls' mettle and see just how willing they are to hold through the first signs of selling that we get. As I mentioned with Frank when we were talking in the Discord, if we hold the 50, and I don't just mean yesterday and today. I mean over the next few days. If we can hold and maintain the price action above the 50, that's actually pretty bullish. Now, probably a little bit more bullish than I'd like. And I know that's kind of a weird way of saying it, but I'd actually prefer that we pull back a little bit further and set up a bounce play off of some support levels. But market always gives whatever it wants to give, right? And so the idea here is if we hold above the 50-period moving average over the next few days, then what ends up happening is we set up a bullish continuation pattern. We'll set up a bull flag, whether it forms like this or whether it forms as a straight parallel channel. But we'll have a consolidation range, and then from there, likely resolve to the upside and start testing a little bit higher, maybe even probing all the way to the 200-period moving average. Now, again, that's going to still play out over the course of a few days. It's not going to play out just off of today's close. But, of course, holding above the 50 today would be the first start of trying to form a pattern like that. Now, ideally, what I'd like to see, what the scenario I discussed last week was more along the lines of if we could pull back a little bit further and kind of come back and retest the bottom of the base that we formed last year, and then kind of have the 20 come up and meet price, and then hold and find support there, then we can maybe find a tradable setup in that respect that gives us a little bit better risk reward for those that are maybe not that comfortable trading momentum, right? Some people aren't really good at trading bull flags or trading momentum plays. Is the trend a reliable indicator of market direction for day trading? Yes, it is, Ron. None of us use it, but it is. If you can if you could get comfortable with any one of those indicators, then it can help you. But it's really off the basis of each individual trader and understanding whether you're looking at the advanced decline, whether you're looking at that. It's more up to the individual trader finding a second indicator or a different way of sort of like a tell, letting you know whether you think the market is moving or not, right? So it is, I think, for the way I trade, the way Frank trades, it kind of overcomplicates the situation a bit, right? Because you're looking at something else. But for traders that want that sort of second opinion, it can be a reliable way. Just the same as even just having an oscillator on a chart can help some traders. It all comes down to how you trade and whether you could find value in any of those indicators. But I will say this: people that have the trade in the advanced decline, along with a bunch of oscillators and all kinds of other stuff, they end up looking at too many things, and what ends up happening is that they either wait for too many things to coincide, or they go off of one indicator that's not really giving you the true price action, and they kind of home in on one thing. If they want to go long and everything's telling them not to, but then the advanced decline jumps up, or the trend does, then they jump in, right? And so it really just depends. It's my kind of my answer for that. Okay. Sorry, jumped off topic real quick, but those kind of questions that's not really a chart question. I'd rather just get that out of the way. Hope that helps, Ron. Now back to where I was discussing on the S&P 500. If we pull back and come down to test the bottom of this base, and again, you can see basically we formed a nice base, right? If we look at the weekly chart, you can see we formed a nice base throughout the course of last year, right? And we've kind of come down, and then last year, obviously, we crashed below it, and we came back up. And the question was, when we come up and test the bottom of that base, were we going to stall out and then roll right back over, or climb our way back in? And basically, all of the indices, with even the small caps to a certain extent, have made their way back into the base, right? So overall, that's a good sign, and it shows that we are not really ready to roll over and head down to new lows. Now, again, I think that this test coming up is the more critical test, because if we roll right back over and fall outside of the base and start probing towards these levels below last year's price action, then there's a decent chance that we continue to head lower and start to maybe challenge last year's lows. But that's still a long ways away. I think at this point, the idea is, as long as this selling doesn't take us past maybe 258, 257, 255, depending on whether you want to count the wicks as part of that base, we're okay. And then that should set up for a bounce, and we should start looking at taking trades to the long side as opposed to shorting. Those of you that follow me on Patreon, you'll know that yesterday I put up two short trading ideas. And the idea behind it was, at this point, the bulls have not completely proven that we can't drop again, right? So it's worth our while to keep an open mind to different ideas and to still look at short trades. Whether those trades actually resolve or not is a different question altogether, but it's worth keeping an eye on it, right? But I do think if we pull back and hold steady at this 258 level and start to make our way upwards, at that point, I think we need to shift back into just trading to the long side until we see another change in character in the markets. And so I think that we are at the cusp of really deciding whether we should be looking to trade long or short. Over the last few weeks, it's been difficult. We've had a really strong run-up, but I think it's been a tough one to really trade consistently unless you're day trading, because we're not at a spot right now where the markets are really in a safe state, right? We had dropped a low key support, and then we sort of just run straight up without really giving traders a pause and a good risk reward scenario to go ahead and try to go long. Anyone that's been going long over the last couple of weeks has been chasing price action unless they found the name that was sort of lagging and actually set up a nice consolidation range. And so other than this one momentary trade off of a little bull flag, most of the trades to the long side have been kind of difficult. And I think we've reached the point now where if we can consolidate in this area, whether it's the bull flag above the 50 or whether we pull back and bounce into the 20 and into the support area, once that sets up into a stable consolidation range and we start to move past it, then we can start looking at some nice long trades with good risk reward. So I think we're getting close to there. Now, keep in mind, again, we are now smack in the middle of earnings season. We have, I think, a relatively quiet week this week over the next couple of days, as far as we have a lot of names reporting, but none of the major names other than IBM that reported yesterday. But we have a lot of big names to report next week, and that could have an impact on where we go with the markets. But so far, I think overall, earnings season has been sort of positively received, and we'll see whether that can continue. I know Netflix had a miss, and they did drop, but it didn't really affect the markets at all. And I think it's going to be more a question of what happens as we move forward, with Apple and Amazon and Google. Let me read what Ron said real quick. You don't use it as much as intraday candles, intraday patterns. I find those. All right, so yeah, and I agree with everything you just said. The intraday candles, intraday patterns, and the 5 and 15-minute charts are by far more reliable for trading, whether you're trading futures or day trading stocks. And yeah, exactly. You can go into more detail, but it's a whole webinar in and of itself. Maybe that's something we should do. Frank and I should maybe have a day trading webinar where we just go over different styles and different ways to day trade, right? That would actually be a really good idea, and that's a good question. But yeah, for this,
Yeah, like Rob says, that's a whole webinar in itself. I actually use this for day trading. I don't use that trend as much, Ron. I find the candles, the intraday patterns are much more powerful than just using one indicator. No one indicator over all the years that I've been trading, no one indicator is 100% accurate, whether using candlesticks or stochastics or VIX or whatever you want to use as your indicator. It's not 100%. They guide you, but what you want to try and do, and think about it this way, you want a bunch of things to come together, and that's what you can talk about in a webinar, Rob, is when you have a few things that go together. So you got your candles, your time of day, and that's one thing that I use a lot, your key pattern, and that keyhole number that just broke through. So say right now, I was watching 1445 on RTY. That was actually the trigger for me to go long, but I needed to see it come up. So I'm using the candles as my guide and the fact that we've been getting lunchtime moves, which we never used to get. So it's constantly shifting as to how you're going to be doing your intraday trades. But just a question like that is so vague to use trend as an indicator. It's not a good indicator. No one thing is. But if that along with something else gives you a good read, then that's when you do it. Okay. But like I said, it's more of a not even one webinar. You actually could do a whole course on this and how do you use it, what are the most reliable indicators, and that to me is more powerful. Okay, thanks, Rob. Sorry.
No, thank you. Thanks for the response. And I do want to point one thing out that Frank actually mentioned here, and that is, and again, we're going a little bit off topic, but that's okay because that's the point of these Wednesday webinars. I always say when you guys ask questions, it doesn't have to be a specific chart. It could be a question like that. And any of these kind of questions help us further along as traders, then that's fine. The one thing I will say is some people use the trend, some use the advanced decline, some use other things. Frank uses key times a day, and so that's sort of his. It's not an indicator per se, but that's his little extra helper. And a lot of times he waits for these certain times of the day where there are often reversals. And so what he'll do is instead of looking to see, is the trend or is the advanced decline confirming what I'm seeing, or is the MACD confirming what I'm seeing? What he does is he's like, it's the Euro close. We normally see a reversal around this time. Is the move that I'm seeing occurring at a time where we typically get moves, right? So in a sense, he's found a different indicator that works for him, which is just looking at certain times of the day that tend to favor reversals, right? Because of different market dynamics. So as long as a trader you find one thing that helps you, that's fine, right? And it's as long as you're not sitting there and you have like 8 charts up and all just trying to help you trade a 5-minute chart of the Russell, then you're okay. But it's really an issue of just finding the one extra indicator maybe that helps you if you need that. Some people don't. And for instance, for me, I don't tend to use any indicators. To me, that little extra helper or crutch that I use is the trend lines, right? The trend lines that I draw on my charts are what help me decide whether I should enter or exit a trade. To me, they make it crystal clear. You set up your trend lines and you don't trade until they break in one side, and then you stop out or take profits when they get to the other side. And so while Frank uses key times, I might use trend lines. Someone else might use something like the trend of the advanced decline. But it all comes down to whatever helps you as a specific trader make your decisions in a better way, right? And so I think that's the key. So I don't want to say that that's not a reliable indicator because Frank and I don't use it. But I find that those things are only good if you have a good sort of system in place or a good frame of reference for them to help you make your decisions, and not just base them completely off of that one indicator.
Yeah, or when you combine it with something else. When you combine it with something else, Ron. By the way, Rob, I just got filled on 5 and then another 5 contracts.
Awesome.
51 and 52.
Yeah, I told you, look at a good time.
Combine them, Ron, with something else, and then that'll give you a more powerful read rather than just concentrating on one. So remember, if it was just one, it would have already been figured out by somebody, and that's all they'd be using, right? As the market shifts, as things change, you have to adapt with the market. So say today, the reason why we were looking at the daily charts with Rob today, and I'll give you the reasoning why, is whenever we hit these key levels, like the 20-day, 50-day, 200-day, those are important shift points or support levels or resistance levels. Okay, pretty easy to understand that. If we drop below that level, then we're going to go further down. We hold that level, we're going to support and come back up, like Rob said he would love if that would happen, if we came back up and held the 50-day. So we both trade a little bit differently, but we see things very similar when it comes to key levels like that. So even though today I knew what he was going to say, we discussed it anyway because I liked how he approaches it. So he was looking at more, I think we're going to hold, and I think this is going to be bullish. And I was thinking more, hey, if we drop back, I think the shorts are going to work out better. So putting that state of mind, Ron, and understanding, hey, we're at a key point today. Is this the day I want to trade, or do I want to wait that we stay under that level or stay above it? If you stay above it, your longs are going to work out better. If you go below, then you're better off to wait for a dip if you're going to go long, or consider shorts into that drop while you're still under the 50-day SMA and see if we've reached the 20-day. So that you're already planning ahead of time before tomorrow even comes. Does that make sense? So today I could have traded here or I couldn't trade. I decided to trade. Both me and Rob like that setup past 12 noon. And usually I hate trading during lunch hours, but I found the pattern lately that we've been moving at lunchtime between 12 and 1 o'clock. So those are things that I remember and I make a note of, okay? But most times you may see me not trade for 6 months at lunchtime or longer. If I see that pattern changing and I keep missing it each day, then I'm going to try and trade during that time. Or like what Rob says, the Euro close, those are very powerful times for me after 2 o'clock in the afternoon. So I have a whole list of different key times a day that I watch. And I usually stay within that guideline. Why? Because it works for me. Okay. So does that make sense?
All right. Thank you, Frank. And yes, Scott. Well, I don't know about 45. I mean, the last 45 days have been different for day trading, but I'd say even that you could cut in half and say the last 20 or so have been very different from the 20 to close out last year. And definitely there's been a big change in volatility, especially over the last couple of weeks where it's been really tight ranges and mostly one direction for the day, as opposed to a lot of the volatility we saw at the end of 2018. So that's another key thing to keep in mind and that's really the focus and the reason I do these Wednesday webinars is that I want to understand what environment I'm in when I'm trading, whether you're a day trader, whether you're a swing trader, whether you're trading options. You want to understand the environment. So, and that's what we try to do the most on these Wednesday webinars is understand what environment we are in as a trader. A lot of times when I make these calls or when I'm looking at the S&P 500, and I know I've said this before, but I'll say it every single time if I have to. I'm not necessarily looking at trading the S&P 500 or trading the Qs. I'm trying to trying to understand what environment we're in to figure out what trades work better and to figure out what names I should be looking at. And that's why we go into so much detail looking at these four major indices. Is really we want to figure out what is the market doing. And once we do that, we should have an easier understanding of what types of trades we should be looking at, or even looking at any trades whatsoever. Maybe we should be looking at Forex, or maybe we should be looking at futures or options. But the idea is to understand where we are in the market, right? And so, again, with the S&P 500, as you can see, we basically either stay above the 50, which right now we are holding. We had a nice little bump up, but a lot depends on how we close today. Today's still been a pretty negative day, and despite the bounce that we've seen intraday, we need to see it close above this level before we could really have any faith in that. If that's the case, maybe we form a bull flag here, at which point we could look at a continuation above and into this area around 275. If we falter here, then I suspect that we drop and come back down to about 258, and I think that's the key test. I really want to see us hold above this level. If we can hold above that level, then I think we'll get a good buy the dip play around there or slightly below it, as long as we test the 20 and don't really fall below these wicks. If we fall below the 20 and below this area around 255, well, then we have to kind of come back and sort of reevaluate where we stand and what we're thinking about the markets. Now, if we look at the NASDAQ and we look at the Qs, you can see a lot more room to the downside before we really have to panic. We're at the 50, same as the S&P 500. There is more room to the upside, up to the top of this channel. You can see the NASDAQ formed a very nice orderly channel for the most part towards the last quarter of 2018, and really just fell apart at the end during the holiday crash that I don't want to call it a crash, but this big swift drop that we had at the very end of the year. And then we of course turned around quickly and have made our all the way back up to almost the top of that channel. We went right through the 20, right through the 50. And at this point, we're right above the 50, and it's the same analysis as the S&P 500. Are we going to hold above the 50 and set up a nice little flag to then make our way back up to the top of that channel? Or are we going to drop and test the bottom of this big range and maybe the 20? You can see the 20 period is coming up quickly, so the NASDAQ's showing a little bit of relative strength in that it can test the 20 without having to come back and test the bottom of this base. And that would be the ideal scenario here, is we test the 20 and don't even come down and test this base to show that there's still relative strength in the tech names and that they are still on their way to test the top of this channel. And I think once we get to the top of that channel, we probably consolidate again, and then we see whether we can break outside of it. If we break to the upside above this channel again, I think that's a really positive move. And puts us probably a little bit ahead of schedule of what I anticipated a couple of weeks ago on the major markets. I thought we'd spend a little bit more time consolidating, and that might still end up being the case. But if we get above this channel, then I think we're a little bit ahead of schedule. We can actually start looking at even further upside. Although, again, we still haven't seen any sort of real major selling yet, and I think that's the key, is whether we get it now over the next week or whether we get it once we come up to the top of that channel. At some point, we're going to have to see more substantial selling in the markets and see how the bulls react to it. But at the moment, I'm not really fazed with what I'm seeing. I know there was a little bit of panic. I don't want to say, well, a little bit of fear in our Discord chat earlier. We're, looking at the market and the fact that we're down 2 days in a row. But frankly, I'm not scared of this at the moment. I don't think this is anything bad. I'm not worried that all of a sudden we're going to head back to new lows or to last year's lows. I don't think we're anywhere near discussing that right now. I think at this point, it's a matter of seeing how we handle the selling that's coming in. And I think we got plenty of room to the downside before we need to really worry about a return to the price action we saw at the end of last year. I don't think there's much more to add to the Qs. I think the Qs are going to move a lot more next week when we see Apple and Amazon. I'm not sure. I think Amazon and Apple report next week. I'm not sure if Google is also. Let's take a quick look. So we got Google February 4th, so that's still a couple of weeks away. Amazon is on the 31st, which is next week. Apple next week as well, and I believe Facebook should be next week as well. Yep. So you can see next week's going to be a big one, and there's probably going to be some big fluctuation on the NASDAQ when those names report, and actually in the markets in general. All right, so let's move on to the Dow Jones. And you can see the Dow Jones also holding above the 50. A little bit, relatively speaking, stronger than the S&P 500 because the bottom of today's price action just sort of touched the 50, and we're actually holding above this key level here, this 244, which is analogous to this level on the S&P 500, this 263 level. And you can see we're struggling with that level today on the S&P 500, but we're actually above it on the Dow, right? So a little bit of relative strength coming back into the Dow Jones. Again, we've had this huge move right through the 20 period, right through the 50 period moving average. And the key again is it's the same thing, basically. If we hold above the 50, we'll form a little bull flag here and probably come up and test the 200, maybe even go a little bit higher. If we falter and sort of lose this level, as long as we stay above the 20, as long as we stay above this 235, we'll be all right. We'll be fine. And I think that'll set up a nice buy the dip play. In a lot of respect, like I said before, even though it's more bullish to stay above the 50, I think if we fall back and test these lower levels, that gives us much better risk reward and maybe even a cleaner setup. But if we have to trade a bull flag, then we trade a bull flag, right? So if things hold up here, then we can start looking again at more bullish plays as we start to sort of resolve and continue trying to play a little bit higher. But I think, again, because we're in earnings season, a lot depends on how these names continue to report and how the markets move. So I'm still trading a little bit more cautiously because, again, during earnings season, my major focus is earnings trades. I think that's the easier money for me to make, and so that's my main focus at the moment. And then to sort of speed it up a little, let's go to IWM. And here are the small caps. Now, you'll notice the small caps are actually technically below last year's base, right? Here's the major base that we formed, not just last year, but even into the end of 2017, right? And for the most part, you can say it's something like that, right? And you can see we've fell below it, we came back up, and we're actually still struggling to stay above that level, right? And so this is the most bearish of the four charts. We've expected that. As I said last week, I'm not overly concerned with the small caps not being in that base. They've underperformed quite a bit over the last few years, and it's shown that even if they underperform, they might drag the markets back a little, but they're not going to be the reason that we sort of head back to new lows. I think the key is as long as the S&P 500, the Dow Jones, and the NASDAQ stay above those levels we just mentioned, then we'll be fine as a whole and as an aggregate in the markets. So even if the small caps fail at this base and head lower, I think we're okay overall. At this time, I'm looking at the small caps more as an indicator of when strength is kind of coming back in. And if they can sort of resolve to the upside and start making their way higher, then I think that bodes well for the overall markets. But I'm more concerned, and I think the easier tell right now is to see what the other three indices are doing rather than what the small caps are doing. We had the nice bull flag here, and we came up, and we're holding above the 50. So relatively speaking, just over the last few days, the small caps are also doing a little bit better than the S&P 500 because we're actually above the 50. But there's still some work to be done here. And I think the key level here is 145.80, 146. We need to get above there. And if we do, then at least it shows that the small caps were able to follow the rest of their peers and get back into last year's base. And at that point, then, again, it shows that the bulls are in control again. And I think that's the key right now is who's controlling the market right now? Is it the bulls or the bears? To frame it in a different way, what is the market doing right now? Is it looking for buyers or is it looking for sellers, right? And I think at the moment it's looking for sellers. It's moving up and trying to figure out where people want to sell. And at the moment we found a little bit of selling pressure. And now the question is, are there enough buyers to continue pushing us to look for more sellers higher up? And that's where we stand right now. If we drop below the 50, then we're going to head down and test the 20. And again, because IWM is the weakest of the four indices, I suspect that if all the indices come back to push and test the 20, IWM will probably fall below its 20 and maybe even head down to this 134, 130. 133 is a little low, but maybe the 134, 135 area, and see if hopefully this area can sustain us for a bounce. I think overall, we're in a pretty positive spot. Despite the fact that we've sold off in the last 2 days, we haven't lost a lot of ground yet. And as long as we stay around these levels, then I think it's a positive. Now, if we do lose these levels, then it comes down to how far down we go, right? And as I mentioned before, as long as we don't lose and fall below the base that we're back in across the board, then I think we're okay. If we fall below the 20-pair moving average, then we need to step back and wait a little bit longer. And at that point, then those shorts that I recommended yesterday would be working pretty well, and we could start looking at more short plays. But for now, we just have to see how we navigate the selling that's coming in and where we move in the future. But overall, I'm not that worried about it. And I'd like to see, again, whether we could hold at this one or the next level. But overall, at this point, I don't think there's enough selling pressure for us to get into too much of a worry or a panic about what the markets are doing. So that's it for the four markets. I think we're still in a little bit of a waiting game for the market to sort of give us a better pattern to go ahead and play a little bit more aggressively. But I think overall we're in a better spot, and I'm a lot less worried now than I was maybe 2 or 3 weeks ago. And we'll see again. It's still pretty early in 2019, and we're still not really sure how this year is going to work out. But my impression last year was that this year would just be a continuation of last year's chop, and we continue to form a big base, something that might take a couple of years to fully flesh out. But the way we crashed last year and really fell below that base had me doubting whether we could continue along those lines. But I still think overall, and this is by the way, guys, this is pure conjecture. This is not based too much off of price action, but my thinking is still that we are going to spend a good portion of the year just trading sideways. But because of the way we closed last year, it might be a situation where we do something like this and trade somewhere along these lines, and maybe even at some point test those lows. But just sort of base out and continue to trade sideways, and continue to grind and really push back and forth. At the moment, we're coming back up towards the top of that range, but I suspect that it's going to take a long time to sort of work off some of the excess that built up during the rally that we saw in 2017 and the beginning of 2018. And so, again, that's just my theory. I wouldn't trade based off of that, but it's what I was expecting last year was that we'd trade sideways and form a broad corrective range. And if you look at the last time we did that, it took a few years, and there was a couple of big swings back and forth. But overall, that was what we did, was we traded sideways. Now, again, it's a little bit different this time because of the way we closed 2018. We didn't really lose that much of a key level during 2015 and 2016. But sometimes they rhyme. They don't necessarily copy each other exactly when you see these moves over and over. All right, so let's take a quick look at the U.S. dollar. We'll look at gold and silver, and then we'll move on to the chart requests. I see, Ron, you want to look at PVG? We'll look at that. So, Scott, you're saying, so you don't think there will be another pullback at this? I think that question, Scott, depends on the time frame. Do I think we're out of the woods and we don't test the lows? 100% certainty? No, not at all. However, the way we stand right now, I think that the shift, and again, you mentioned that the last 45 days have been different day trading. And like I said, I think the last 20 have been very different from the previous 20. I think the market character has changed enough where at the moment, I'm not worried about new lows. That could change, of course, but that's not my concern. At the moment, I'm not concerned with new lows. I think we found a bottom. And like I said, the market has shifted in character, and unless we see a big shift in character again, I think the lows for the moment are out of the question. Now, from here to the end of the year, no, that's a long way. I'm not going to be able to, nobody predicts price action that long for this small of an interval, right? But I think over the next few weeks, we're fine. And I think once we finish earnings season, we'll get a better idea of whether these lows are going to be retested soon, or whether that's something we wait for a little bit later on, right? But I think at the moment, and I think the key again is how we respond to this selling in the S&P 500 and the other indices. If we stay above 258 and we start making our way upwards, then I think these lows are in the rearview mirror for at least the next few months, possibly even up to the next earnings cycle, and then we see how that works. But I think for the moment, I don't want to say that there's no chance that we don't test them, but that's not a concern for me at the moment. Yeah, 60 to 90 days, that might be. That's possible. That is certainly possible, because again, we haven't really seen enough selling yet to see whether we can sustain price action above here. But to me, if I want to draw a line in the sand right now, it's 259 to about 257, 256. As long as we stay above there, I'm not concerned. If we fall below there, then I'm very concerned we test the lows. Okay. But yeah, for now, I'm not worried about them right now at all. That might change next week, but we meet every week, so we can readjust our thought process. But at the moment, I'm not concerned with them at all. All right, let's take a look at the U.S. dollar. The U.S. dollar has done well over the last few days. Now you can see the last couple of days we're down a bit, but we had a nice bounce after sort of losing a lot of ground, right? Now the interesting thing is that when you look at the euro versus the U.S. dollar, the euro lost ground, and the U.S. dollar picked. Again, this is inverse, right? So up is good for the euro, bad for the U.S. dollar, and the euro lost a lot of ground and is now starting to stabilize again, but it's on the wrong side of these trend lines now, right? So this actually is favoring more strength coming out of the U.S. dollar, which is a little bit different from what we're seeing on UUP, right? Because on the UUP index, this is showing eroding price action on the U.S. dollar, and it's showing the U.S. dollar that's starting to lose strength. Despite the fact that we had a nice bounce here, overall, you can see it's starting to roll over. You can see the moving averages turning down. We lost this ascending trend line, and while we've come back up and bounced, this is almost a reactionary bounce to maybe come back and start heading lower. So this is a very different picture from what we're seeing on the euro versus the U.S. dollar, which is really the case of the euro losing, sort of eroding its price action. And the big key here is, can it get back above 114? We mentioned this last week. I'll mention it again. This is a major level with a lot of ramifications across the board for currencies on what happens here at this 113 to 114 level on the euro US dollar. This is pretty key. It was a huge base that we formed from 2015 to 2017. We zoomed right past it at the start of 2017, and only now are really retesting it with any kind of real conviction. And a lot is going to ride on what happens here as far as the euro strength and the US dollar strength as we move forward to 2019. So this is a pretty key area. And at the moment, it's hard to say what's going to happen because we're seeing a little bit of a bounce here, but we've lost all the moving averages. We've lost two different trend lines that are converging. And overall, this would be a negative, but the way this has behaved, I wouldn't be surprised if it comes right back and crosses through all these indicators again, because we've had 1, 2, 3, almost 4 false moves now, showing that there's just it's right at equilibrium here where it's really struggling to figure out where it wants to go next. Now, if we look at the U.S. versus the Canadian, a little bit clearer of a picture. We had the big drop after that nice trend upwards, and you can actually see it formed the bear flag, but it's actually resolving to the upside, showing more strength coming into the U.S. dollar. Overall, this is a positive for the U.S. dollar, and at this point, it looks like maybe it found the support level it needed to find. I would not necessarily expect the trip back to its previous highs, but at this point, it could probably consolidate and set up for a nicer bounce play. And if we look at the U.S. versus the yen, it also has shown a nice bullish reversal here, right? So I think all three are showing a slightly different picture from what we're seeing on UUP. And overall, showing some strength coming into the U.S. dollar, which tends to bode poorly for the markets and for gold and silver. Not necessarily a lot for the markets, but this could put a little bit of pressure on the markets, and that might be a little bit of what we're seeing. Also, gold and silver, which I've been pretty bullish on, have started to lose a little bit of momentum. You saw they were printing a nice bull flag, but we never resolved to the upside, and we sort of gapped a little bit below that flag now. So we're starting to lose a little bit of strength on GLD and SLV. And at the moment, I would say I'd like to see a change in character in the U.S. dollar before I go ahead and look at playing some of the gold names that we've played over the last month or so. There were some nice ones that were forming nice flags, but I was seeing some weakness across the board on them, and so I sort of stayed away from. I mean, they never resolved to the upside anyway, so it wasn't really necessary. But for those that are wondering, a lot of times in these scenarios, I'll look at certain names, right? So we'll look at maybe like you look at Kinross and it looks fine, right? This nice little flag here. This is one of the ones we shared on the Patreon page. It hasn't resolved to the upside, but then you'll see something like this name, which is another gold miner, and you see it losing a lot of traction. And if you see some of these names lose a lot of their value, or start to falter, then you can expect a name like this to maybe not trigger to the upside. And I think we're seeing that across the board, and that's why we're seeing some of this pressure coming in on some of these names. So I think overall, I'm sort of holding off on gold right now and waiting to see what happens with the U.S. dollar. And then finally, we have oil. And oil has, I think, reached a good resistance level. There's a lot of oil names that are printing nice little bull flags. And there's a possibility that they resolve to the upside. If they do, there's a decent chance it'll be off of the heels of oil breaking above 54 and starting to make its way back up. Now, it is right back into that range that it spent a good portion of the last several years in. And at this point, I'd suspect some resistance to kind of come in, but it broke through last time with such strength and then broke right back down with such weakness that I'm kind of curious to see whether it tries to make its way outside of that range or whether it falters and stays in this range a bit longer. I think at this point I don't have enough conviction either way, but we'll see what happens here. If it forms a nice flag and continues to trade tightly just below 54, then that might mean that it's ready to make its way back above it. If we lose something like this, then we'll know that it needs to come back and test at least the middle of that range. So I'd watch this trend line right now if you're looking at trading oil or looking at trading any oil names. All right, so that covers it for oil, gold, and silver. I think I'd stand away from them for a minute while we watch the U.S. dollar and see if it gets a little bit more of a bounce, a little bit more strength. Let's move on to the chart requests. There's only one right now. Ron, you're looking at PVG. But if anyone else has one, we have about 15 minutes. What are these guys? They're miners. What do these guys mine? Do they mine? They don't mine precious metals, but all right. Well, these guys have struggled. Okay, so first things first. Anytime I get you think gold maybe? All right. First things first. Let's take a look at what their earnings are. All right. It's February 14th, so we got time. What is that? That's 1, 2, 3 weeks. All right. So 3 weeks. They mine basic materials, so maybe gold, maybe not. I see a couple of different things here, and I don't think it's that positive. All right. So first, we have a couple different. I hate when this happens. Let me move this a little bit. All right. All right, so we had a nice trend up, and that changed into a trend down, right? It is at the bottom of that trend, and it is at a pretty decent support level, and we've got some nice support wicks here. If I were to trade this to the long side, it probably has to at least clear all these wicks, and then from there you could play it up to 740 and maybe up to 770, and then possibly all the way to the top of that range. You wouldn't get that move before earnings. I would say since you're trading and there's earnings coming up pretty quickly, if you can get something around 770, 760, 780, that would be pretty good. It could be worth a shot here. It is showing nice support here. We got a nice candle pattern, and we go down to maybe like a 30-minute chart. it did break the first downtrend, right? And so now it's a matter of it. Over the last few days, it's done this. And I mean, you can see pretty clearly, right? If we move, let's move to like a 15-minute chart. Right, you have this key level here, and I think I could probably move this up to something like that, right? And we're right at this convergence of these two trend lines. As if it could push past this, it has some momentum a little bit upwards, and it could possibly make its way back up to, like I said, like up into this area, the 740, 755, 780, somewhere in there, and I think that would be okay. I'd have to see what it does as it breaks through these levels. So I think that's the key. A lot of times these candle patterns look really good, but you still need to see confirmation that they're going to hold. So a lot of times when I'll see tweezer candles like this, right, you see these two long wicks, is I want to see the price action not just print the hammer, but then get above the hammer on the next candle, and that's the candle you typically want to buy in those scenarios, right? So that, yeah, we could maybe trade this up to the middle of the range before earnings. Okay. Wes, Apple earnings are coming up, but curious my thoughts on the chart in general. I'll give you my thoughts on that in a minute. And then Ron, Macy's, also thinking they're a big player at support. Thoughts. All right, so let's go with Apple first, and then we'll move to Macy's. All right, so Apple. All right, so I actually am kind of concerned about Apple, and the reason for that is compare all the major FANG stocks, right? You look at Facebook, and Facebook has already broken their downtrend and has started to set up for a climb back higher. Now it's faltering over the last couple of days, but you can see the positive price action, right? You look at Netflix. Now Netflix, of course, had a poor earnings report, but they had broken their downtrend and they had a really nice run up into earnings, right? That was the expected move for earnings, and you can see that they've already had positive price action. Even if they pulled back, they've already had a nice change in the way they're trading, right? Amazon has also broken that downtrend and has sort of changed character. What's left? Google, right? Google, not quite as strong, but also working on changing. Well, that one's a little bit tougher, right? I think that they're still struggling as well. And I don't even know if I draw the trend line like that, but they're also in a little bit of sort of stalling out, but to a certain extent, they've also sort of bottomed out, right? And you can look at it like this. They had a lot of this volatile price action. They sort of changed, and they're starting to trade on the other side of this. I think that they still have work to do, but they didn't really fall back as bad as Apple. If you look at Apple, the selling pressure has been totally different. And you can say, yes, they've changed character as well, but that's only if you draw an incredibly steep trend line, right? And so you can see how much weaker Apple has been than the others. And even now, it has changed character. I don't want to say it hasn't, because it did sort of break that trend. It's just that trend was so steep to begin with. And it really hasn't done much, and it hasn't been very positive since then. Now, they already warned that guidance was going to be, or that earnings was going to be bad, right? So there's always the chance that everyone expects earnings to be bad. If it's not as bad as they warned, then this will go up, right? And I think earnings could be the catalyst that changes it. Would I want to guess and just buy this hoping that earnings changes? No, not at all. I would probably wait. I mean, normally if I trade Apple for earnings, it'll be both directions, and it'll be a volatility play based on whether I think it's going to move more or less than the expected move. But I wouldn't guess on the direction on this. This thing has been overwhelmingly weak for a while, but I wouldn't want to guess to the downside, because they've already warned to the downside, so they could surprise to the upside. But I also wouldn't want to guess to the upside because they've been so poor. So I think overall I'm just watching and see what happens. But I'm not impressed at all. And I think that they're definitely struggling when you compare them to their peers. That being said, they have dropped quite a bit. And the one thing I will say is, if you want to buy Apple for a long-term play, it might be okay to maybe look at some at these levels. There is more room to the downside, down to 117, but that's a long ways away, and I don't think it gets there even on a poor earnings report. These guys tend to move 5 to 6% during earnings, so it's not like they're really an insanely volatile name. You look at the mean, right? It's 5%. Sometimes it can move up like 6, 7%, but for the most part, it's 3, 4, 5, 6%, right? So, if you were looking at it as something where you want to play a value play because you think over the next 5 years this will go up, then it might be worth a shot. But I think I'd be holding off on those kind of like long-term ads until I see more weakness in the market. Like we mentioned earlier, at the moment, last year's lows seem off the table, but if they end up coming back on the table, then that's when you want to start looking at those 10-year plays, right, or 5-year like holds. Is once we see what happens the next real test of lows. At the moment, I think Apple's at a good discount, and it might be worth a play, but I would only nibble. But I again, only if you're a long-term trader. I think as a swing trader, there are other names that are doing better, and that would worry me less during earnings. I think for earnings here, we'll get a much better picture of what Apple wants to do next after earnings. But I don't know. I think it's just so much weaker than the others that I'd probably hold off. All right, and then the last one is Macy's. All right, so we got about a month on this one. So, and again, guys, keep in mind, always do this, right? Every name that you're going to look to trade, always figure out what the earnings date is, because you don't want to get caught on a 5 or 10% swing on a stock where maybe your stop was 2 or 3%. So you're thinking they're a big player at support. Thoughts? All right. Well, let's look to see what the support is, because at the moment on the daily that doesn't look that impressive. All right. So there is some support here. I don't think it's a major support level. All right. Now we had that nice trend that broke, right? And all right, so I mean that's kind of a key level. That's pretty ugly. And well, I don't need to draw that horizontal level, but there's a level here around 28 that's kind of important. All right, so this is what it's doing. This $24 level could be a key support level. I'm not convinced that this is a bottom yet. I know we had a little bit of a V bottom here, but we've lost it in the last 2 days. I would wait on this until it got into a tighter range and then try to second bounce. And then from there, I would trade it maybe to the top of this trend line. That could still play out over the next month, but I'm not ready to trade this yet. I think I'd want to see it sort of come back and retest 24, and then maybe break this trend line at a lower level to give me better risk reward. I wouldn't trade this yet. I think it needs more work. Okay. All right, guys. That covers it. I think that's everything. Let me double check that I got all the questions. If you guys have any other questions, you can always ask Frank or myself on the Discord, or you can ask me on Twitter. You can also, like I said before, if you want to see more of my thoughts, or if you want to see the recording of this video, you can see it either on YouTube or you can see it on patreon.com/stockdarts. I'll update it later in the day once it's done with the whole conversion process and all that other stuff. Other than that, I hope you guys have a good rest of today. We will meet again next Wednesday. Have a good rest of the week and the day.
Okay, good job, Rob.
Thank you, Frank.
Was it the best? Hey, Ron, Scott, does that make sense? What I typed to you was a long answer, but see if that makes some sense, or I can go through it now that Rob's done. It did? Okay, good. That's a good plan, because this way you don't have to like guess. If you're going to be in longer term, you're usually not going to stop out, right? So imagine, what's his name? Warren Buffett trading with stops. If he gets into something, he's going to end up holding it for years and years, right? His plan is actually don't ever sell. So if you go with that plan to just buy key dips, right, or major market pullbacks, that's actually a good strategy. It's worked for me quite well. Okay. So what you do is you go with the plan of picking up, say, a third, if we hold that 50-day, a third if you want to wait and buy into the 20-day, a third if you get into those December lows, which would be pretty good deals down there, and a third if for some reason we ever collapse even more. So I think that's a good strategy for longer term trades. For swing trades, yeah, you're going to have to keep stops in place if you're getting in and out. But longer term, I wouldn't concern too much about it. Just get in and then just wait for a key major drops to position again, if that makes sense. Okay. All right. See you guys. Thanks, Rob. Have a great day.
Thank you, Frank. Yeah, I'll see you in the chat after lunch. Good afternoon. Good. Thank you guys again, and we'll meet again.
Yeah. See you.